The agenda here is like, all right, so why commercial? Why should you even be listening to me? Like, why do I even have credibility to speak on the subject of commercial real estate? Why I'm doing this, and also the three pillars of any commercial real estate deal. Okay. So the reason why commercial, and I think that we were talking with before we recorded this with Roxanne, is that I came from a background of building a small multifamily portfolio. I started this journey in 2006 with my first property, which is a four-family property. I focused on small multifamily, and over the course of 11 years, I built up to about 76 units. Was able to replace my income by the time I was 33 years old and walk away from my job. But it took a lot of hustle. I was closing 1 to 2 deals a month at the time. I look back and I don't even know how I did it. I was thankfully my wife stayed with me during this process. But it was a lot of work. And so I got to this, seminal point, this thing I was obsessed with over the course of 11 years, financial independence. And I wanted to go backpacking through Europe for 2 months at a time with my wife, and it wasn't going to be a thing if she was stuck in Hilton High School teaching math. She was a public school teacher, not very flexible schedules outside of the summer. So so this kind of like led to the seminal moment of I needed to find a way other than what I had done in really hopping on buying 1 to 2 deals a month in small multifamily to deals that are going to have a significant financial impact to be able to replace her income. So I finally built up the courage to buy a commercial property. It was $1 million. I had to raise $300,000 in capital. Never raised capital before, besides working with hard money lenders on financing small foreclosure properties, that sort of thing. And so this is the first time I went through the process. I did it alone, learned a lot, made a lot of mistakes. Some that took years off my life, but I was able to get this deal across the finish line. Was able to increase the value of the property from 1 million to 1.6 million. Was able to refinance that property, pay my investors back their $300,000, and that deal replaced my wife's income and added about $500,000-600,000 to her net worth. So at that point in time, I got bit by the bug, and I was like, I can't go back. So I've been scaling ever since then, right? So why commercial real estate? So before I get into why, like what is commercial real estate? A lot of times people think commercial real estate is like, okay, industrial, retail, or office, but commercial is also anything that is 5+ unit multifamily property. Okay. The reason why that's important, the 5 unit or plus, is because that type of asset is looked at by banks differently. And a lot of the theme of today is going to be on financing and how the capital part of the way works. Um, a commercial property has a different type of appraisal. A commercial real estate appraisal is more like a actual appraisal on a business, and a business is valued based upon its income or its profitability. So, for instance, Apple, for instance, as a company, the more that more iPhones that it sells for the least amount of cost, the more value that company is, right? So you have more control over what that property is worth at the end of the day, rather than the residential game, single through four family, where you're hamstrung by what your neighbor's property sold for down the street. So that being said, commercial real estate isn't really even the real estate business. It's like you're buying a business or a company, and you're buying it based upon its income. And if you have a good plan, which we're going to talk about today in terms of how to develop business plans for an actual commercial property, you can be in control of pushing the value on on the asset, and ultimately have scalability, and not having your own capital as your bottleneck as you grow and acquire more commercial properties. Okay. The other reason too is that when you are doing smaller deals, single through four family, there is there's a lot of competition for that. Everybody wants to buy, single through fourplex properties, and there just isn't enough meat on the bone to keep several people interested, right? One thing with larger deals is that when you're raising capital, you have more meat in the bone within which to share with investment partners. Banks want to actually compete for your business, which was completely I was completely shocked when I started doing commercial deals, and banks were actually competing for my business and the loan rather than the other way around, like I was when I was building a small multifamily portfolio. Okay. Um, so this allows you the economies of scale within which to build a team, within which to have a division of labor to really, really take big deals down and actually not be so busy in the process of doing it, wearing all the hats that we do in the smaller deal space, right? And the last reason why commercial real estate, and this is might be a shocker, is it's less competition. If you go to any real estate meetup and you ask, all right, who's buying, who's not buying, but bought 20 unit apartment buildings in the room here? Very little people's hands will shoot up, if any, right? Everybody is there because they think they have the self-limiting belief that, okay, commercial sounds scary. It's big money. It's extra commas involved with it. And they're focused in that space. Okay. So there's less people you're actually competing against on it. Okay. The other thing too is that the commercial real estate transaction space is very highly fragmented, and a lot of the deals, and 80% of the deals that happen in whatever town you are across the United States, 80% of them happen off market. They're deals that trade that you don't even know about. All right, so it's a very highly fragmented market, which creates market inefficiencies that can be exploited. And truly being able to capitalize on that market inefficiency to get great deals in the process. Okay. So that's the why behind commercial real estate. All right. And to put this into perspective, right, I have a small case study here. I'm not going to spend too much time on it, but there's a property that we bought last year. We'll call it 144 Exchange, it's the Court Exchange building in downtown Rochester. Yeah, by the way, I'm based out of Rochester, New York, and all of our holdings are in the Rochester area, mostly city of Rochester. And I'm going to go into why that is later on in this training. But it was a deal that we bought for 2.75 million. We got about $2.2 million in bank financing. We're able to secure really, really advantageous debt on the property because remember the banks were actually competing for this deal. So this was a couple of years ago when interest rates were getting into the high sixes. We're actually able to finance this deal for 5.9% interest and also have a interest only period on that loan for 1 year. So this left me with a gap, right? There's $750,000 we needed to raise on this deal. So that's where I utilize my infrastructure that I built over the last 18 years of doing this to actually to come up with the $750,000 from passive investors. So we had none of our own money into this deal at the end of this, right? I'm going to go into on the capital side or the capital raising side of this training on what the reason behind the importance of being the skill and developing the skill with raising capital. But there is a really, really strong reason as to why you do not want to have your own capital as a bottleneck as you're growing, right? Because everybody's used to, you buy a property and you wipe out your liquidity, and then you're left years saving up enough money to buy your second property, right? And in the meantime, this has happened to me. You can have smoking hot deals, life-changing opportunities come across your desk that you miss out on because you just don't have the dough to do it. Okay. Um, so we bought this property. It's about 8,000 square feet of vacant space in the building. With commercial, the other great thing too is that because it's based on an income or in-place income on which you can buy the property at, we got the 8,000 square feet of vacant space in this property. This is about a 50,000 square foot building. We got that space for free. All right. So there's no economic value tied to it that we paid for in the price, no potential income on that space. So this is the reason why I actually love commercials and asset class like office, industrial, and also retail is that you can get free space, right? We know how much it costs to build a house nowadays, right? It's incredibly expensive. So you can get space for free. Any lease that you sign or lease space that you lease, and by the way, you can be very, very methodical and patient with leasing that space because it doesn't cost you anything to maintain it. You're not paying anything on your debt in order to have that vacant space. So any lease that you sign is 100% profit. And when you have 100% profit on it, you do not have to sign many leases in order to be able to really explode and massively increase the asset value when you do that. So we were in due diligence on this building. We had a 60-day due diligence period. Generally, part of our due diligence process as a company is that at a certain point in time, we want to talk to the tenants, right? Ask them, how's the space? Do you need more space? Do you need less space? Are you planning, are you happy here, for instance, right? Getting that qualitative type of data from the actual tenants itself is incredibly important in terms of what our complexion is going to be on the deal itself. Well, one of the tenants, the New York State Court of Claims, was like, "Hey, actually, you know what? We need more space. I heard you have space on the first floor available. Can we see it? My finance director is coming out of Albany next week, and we'd love to see the space and see if it might be a good, good fit for us." So scheduled a tour, walked him through the space, and I was like gobsmacked when the local director said, "We'll take it." I was like, "How much space do you need?" He's like, "We'll take all of it." All right. So what we ended up doing, fast forward, we ended up negotiating a 15-year lease renewal, not only on lease renewal on the existing 15,000 square feet of space that they had, but also bolting on this 8,000 square feet of vacant space. And that lease alone, signing that lease, increased the asset value by $1.8 million and adds about $125,000 a year in cash flow to that deal. This is why commercial. You do not need to do a lot of deals in order to meet your financial goals, right? You don't have to drive yourself crazy in the process and be ultimately busy. So this is also a great business for all of you out there that are full-time working professionals to really build this business sidecar to what you're doing right now. And like I've said before, secretly plotting the escape from your corporate jail cell, right? If you're currently working a W-2 job. So a little bit of background on myself is, these are just some personal details here. My big why around real estate and the reason why I'm so evangelical about it is because I was able to create freedom for myself. And my big why around that was because, I lost both my parents in my 20s. Okay. So I saw two hardworking people doing everything the right way. And they passed away, and my brother and I was dealing with the estate issues. And unbeknownst to us, they were living paycheck to paycheck our entire childhood. And they were never there. They worked like animals, literally. And I was like, I have to figure out a different way to get out of this, right? I had to get out of the rat race, so to speak, as Robert Kiyosaki says. So, um, but I love travel. I love traveling. That's one of the reasons behind time freedom. I want to, I'm not a materialistic person. I'm not obsessed with like having a big house and a fancy car and that sort of thing. I really want to have rich experiences, and rich experiences that are going to pay me memory dividends over time. And travel is not only expensive, not because of its, cost of a plane ticket and lodging and that sort of thing, but it's expensive because you have to leave and not get paid, right? You have to take a leave of absence. So that's a little bit about me. But I've been doing this for 18 years. Current assets under management are about $18 million dollars, and we've evolved into doing more redevelopment deals, focusing on historic adaptive reuse projects. That being said, I don't see anything in the chat. Any questions on what we've covered so far? Because I've been talking for a while. Roxanne, are you trying to unmute yourself or no? Okay. All right. I'll keep going then. So, anyways, there's a little bit more background on me. So I'm locally involved in a real estate community. I'm president of our local real estate investors association, which is a 501c6 nonprofit. Also board member of the New York State Commercial Association of Realtors. So this is kind of like my journey through real estate. So as you can see, I'm not gonna actually spend too much time here because we're already 15 minutes into here. All right. So here's some math for you in terms of setting some goalposts on how much real estate you need to acquire in order to meet your financial goals. Okay. So if your objective is to walk away from your W-2 or not be so involved with your business, or a 1099 independent contractor, you really essentially what you do is you take the money you want your real estate to pay you and you divide it by 0.0022. Okay. And that is going to give you about in terms of like plus or minus the amount of real estate you're going to need to buy, commercial real estate, in order to produce that type of income. Okay. Now, this math does not work for very, very expensive markets like LA, like New York or Miami, for instance. But a lot of us live in secondary markets and tertiary markets across this country. And what is behind the math is essentially our company. We target our assets to pay us 11% return on equity every year. All right. So what we do is we take, whatever income you're going to be. Let's say I want to pick on somebody real quick here. John, John, can you tell me what you want your real estate portfolio to produce an income each year? John Biter. What about you, Nick? I think we've talked about this before. Okay. All right, John.
You hear me?
Yep, I can hear you.
Yeah, so I was trying to get my unmute going. So I don't know. I mean, if I make maybe 5,000 a month at my job, so about 5,000 of income a month.
Okay. So we're going to take $5,000 time multiply it by 12. We get $60,000 a year. And what we're going to do is we're going to divide that by 0.11. Okay, so that's that 11% return on equity that we target as a company. And the reason why return on equity is important for us is because we use other people's capital within which to buy commercial real estate deals. Doing return on investment is not going to make any sense because we're dividing a number by zero. So we take it's essentially a measure of how much we want our equity to pay us on an annual basis. All right. So when I divide that by 0.11, I get $545,000 in real estate equity we're going to need to create in order to produce that type of income. Now, because we generally use with my clients the BRRRR strategy, the buy, rehab, refinance, repeat strategy. Um, Generally, when we refinance the property and pay our investors back all of their cash, we're back up to 80% loan to value on that property. So 80/20, we're divide that number by zero point 0.2. Okay. So divide by zero point 0.2. So that's going to be about $2.7 million in real estate assets, plus or minus, we need to acquire to do that. Right. So the math here is important in that you can set up like, okay, if you're going to be targeting, let's say, $1 million to $1.5 million property, then then you're probably going to need to acquire two deals over 2 year period in order to produce that type of income to do that, and that's very entirely possible with commercial real estate. Doing it the residential way, you're going to have to buy a boatload of properties, pant loads of properties in order to produce that type of income, if that makes sense.
Definitely got some work to do.
So any questions on that before we move forward? All right, cool. All right, so we're going to go over the capital part of things here. And before I get into the different sources of capital and how to tactically use them, I want to go into why we're talking about capital right now. There is this myth out there that I want to put to bed, or put to death, so to speak, and that is find the deal and the money will come. Okay. Find the deal and the money will come. I've tried that. Okay. I did okay, I don't have to worry about the money at all. I don't have to worry about the capital. If I just find a smoking hot deal, then the capital, all the money I ever need just appears out of thin air. Okay. Not true. This happened exactly on that first larger deal I did, the $1 million deal, where I had to raise $300,000. I thought that I could actually go back to my hard money lenders that I had used, where I had borrowed millions of dollars worth of capital from them in order to build my portfolio, paid them several hundreds of thousands of dollars in interest, and say, hey, I got this deal. It's $300,000. I can do it in $100,000 chunks or $50,000 chunks. What do you guys say? None of them put any money into the deal. Okay. So I did not build the infrastructure out in order to be an effective capital raiser. This takes time, and people do not invest in your deal. They invest in you. And they invest in you because you have the KLT factor with them, the know, like, and trust factor. So, and that takes time because relationships move at the speed of trust. All right. So we're going to go over the different capital sources, which makes up the entire capital stack of an actual commercial real estate deal. So we're going to go into the bank capital first. Okay. Because generally when we're looking at million to $2 million deals, there's not a specific like singular investor that's gonna be able to stroke a check for $1 million to $2 million. All right. So you're gonna have to piece together the capital stack with, bank debt and then also private money from your investors. And we'll get into that. All right. So banking rule number one is don't answer questions that aren't asked. Okay. When you're dealing typically with community banks and credit unions, and you're planning on putting together sources of capital from other investors, there is this type of business. Bankers are not really attuned to how deals are put together. So only answer questions that a banker asks you, right? So if you're putting together a deal and you send them your, when you're putting your actual formal credit application into to acquire a property, now they're going to require you to fill out what's called a PFS, or a personal financial statement. And if they see that you have $50,000 in cash or cash equivalents in your balance sheet, and you're buying $1 million deal, it's going to require $200,000 down payment. They're going to ask you this question: Hey, Carlo, do you have any partners? Okay. So, but leading with that, because there's banks will see your deal and just like the deal the way it is. This is what happens when you're flying under the radar with local community banks, and the more information you start spewing out there that they're not asking for can put your deal in jeopardy. Okay. So in terms of order of operations on what you can start doing right after you get off of this webinar is start forming the relationships now with local community banks and credit unions wherever you are in the country. My general rule of thumb is the smaller the better. Okay, on these community banks and credit unions. So, and I'm going to go through the order of operations in terms of what to ask them during this process. The reason why you want to start forming relationships now is because when you actually find an opportunity that really meets all of your criteria, and it's a really, really great deal, and you need to submit a term sheet with your offer on that, first of all, you need to act quickly when you're looking at opportunities, right? Whether they're on market or off market. So if you do not have a relationship established, at least with one or two local lenders that know you, that you've gone to coffee with, that have like gotten to know your backstory, then it's going to be very difficult to get a term sheet. And the reason why I say get to know at least two is because regardless of the year, of the time of the year, one of them is going to be on vacation, all right, and out of pocket. So start forming them right now. All right. So how do you find them? Essentially, it's as easy as Googling. All right. But the really best way is that I know some of you here belong to local real estate groups. You may belong to a local Facebook group, for instance, and just ask your network, right? Who are great local commercial lenders to work with? Okay. But if you do not have that network or anything like that, then actually just Googling, banks, right? And I'm actually going to stop sharing my screen, and I'm going to go to share another screen actually. Um, in terms of how I specifically look at doing that. So I got to get out of this thing here. I'm going to go to, all right. Um, Roxanne, what town are you based out of right now?
I'm near Syracuse.
You're
Probably Americu is mentioned a lot at the real estate meetings, and also Geddes Savings Bank, which is very local.
Okay, so Americu Credit Union. Yes, my client Matt actually has done some deals with Americu. Um, so I'm gonna go
I'm
on
sorry,
here.
was that the question you were going to ask me? I kind of just
Yeah, I know
okay.
Americu is close in your market because we're technically
Yeah,
neighbors here. We're a little,
yeah,
we're a little bit maybe an hour 2 hours away from each other. But
right.
one of the things that I do is you Google, banks in your town, right? And really the quickest way to do this is you're going to go on here and you're going to go and these drop down menus, and you're going to look at okay, so business deposits, checking accounts. This is typically a bank product, right? So business lending. Okay, so we're gonna go here, and here we go. Business loans, lines of credit, credit cards, and real estate. Okay, so this is going to be somebody that I'm going to want to get in touch with an actual specific contact to schedule a coffee or a lunch with. Okay, and we're looking at real estate mortgage. All right, so now when I send a query out on Facebook, for instance, and somebody says AmeriQ, I'm always going to ask, do you have a specific contact there that you can recommend? Because generally with these credit unions, there is there's a certain pecking order with lenders, and you do not want to get paired up with somebody that's like basically just sitting at their desk waiting for their phone to ring, because it's generally going to be the most junior person that is in their commercial lending department. So you definitely want to go in with an actual reference. Okay. John just said, in any community bank recommendations for the Rochester area. Um, Yes, absolutely. John, what type of deal and what type of deal size you're looking at doing potentially?
Probably not commercial yet, so somewhere in the 300 to $600,000 range.
Okay, cool. So I would say family first. Family first federal credit union. They're very, very small. The reason why I explained small and mighty is important is because there is when you're working with a smaller bank, they can be a lot more nimble. And Family First is probably a credit union that most people even live in Rochester haven't even heard of. Okay. And there's two guys that run the commercial lending department at that bank, right? There's Alan Tomedy and his partner. Okay. The reason why small but mighty is important is because when you send them a deal and it makes it past their credit department, for instance. Alan and small banks like Family First, for instance, goes to a partner and he's like, "Hey, I like this. I like this deal. Do you like this deal?" He says yes, and it's approved, and they can submit a commitment letter. So very, very easy and nimble to work with. All right. So when you find an actual bank, there's these certain questions that are going to be important to ask them. Right. Question to ask: what are your typical term? All right. They're going to usually say, all right, 70%, 75% loan to value, or 80, and a 25-year amortization, or 80% loan to value and a 20-year amortization. And these types of things, right? The next thing is like, what types of deals do you like? All right. Family First, for instance, they do not like anything besides residential. So they'll do commercial multifamily, like 5 units plus, but they really, really don't like commercial office, for instance. So you want to know this so that you can actually, update whatever you use in your, spreadsheet. I use my iPhone in the contacts list with whatever lenders I have, and I'll actually take notes on the contacts so I can know exactly like, okay, what is what ticks their boxes, for instance. The other important question to ask is, how are loan decisions made, by committee or individual? Regardless of what community bank you're talking to, there is when a deal gets past their internal credit analysis. This is where you have like a junior person that's out of college that will look at your personal financial statement, look at the deal, look at the rent roll, and all of the financial information you sent to them, and then use their scorecard internally at the bank to do a preliminary approval. Then they'll send it up to the loan officer that you're working with, who's your contact at the bank. So sometimes with banks is that individual loan officer, even if it makes it past initial credit analysis, then they don't have the authority to actually approve the loan. So what they have to do is they have to go what's to called loan committee, right? And so these banks will meet, like, let's say once a week, for instance, or in some cases twice a week, to submit their deals that they're looking, that people are looking to get financing on. And that loan committee is actually made up of other loan officers within the commercial lending department, typically, and also sometimes there might be a member of their board of directors, for instance, for the bank. So part and parcel, this is can slow down the process of approval. We do a ton of deals that are approved by loan committee, but it's just something to be aware of. When it's approved by individual up to a certain amount of debt, then that's more advantageous because then things can move a lot quicker when you're looking to get financing. Okay. Um, the other important thing about committee is maintaining a stellar reputation in your community. Okay. Because bankers talk. And if you have a bad reputation in your community, and there's other loan officers that are on that loan committee that don't like you, for instance, or you've done some not great things, or you haven't lived up to your commitments, that sort of thing, then that reputation can kill your deals in the future. So just being very aware of maintaining a very, very sterling reputation in your community and business and everybody you deal with. Okay. The next question is, what is your max relationship limit? I'm going to pick on Family First here right now. Their max relationship limit, I believe, is $1.5 million worth of debt. Okay. So I like to be able to pick a credit union or a community bank, within which I can grow a little bit with, right? So if I'm looking to buy $1.5 million deal this year, and I'm putting $1 million worth of debt on that property, most likely and I want to buy another deal right after that, then most likely Family First may not be the best fit for me on that, because I want to be able to establish a relationship and grow that relationship as well. So what is your maximum relationship limit? Um, who do you require? This is a really, really important one. Who do you require as a guarantor, and what do you need to see from them? Okay. I put on here the 19% rule. If you're putting together an ownership group of different investors, whether they're passive or active, some of you here may have some actual, like, a partner, a business partner. Um, how who do you require to be a guarantor on the actual debt itself? Okay. And typically, most banks use SBA standards, or Small Business Administration standards, and anybody that owns over 19% in the actual membership interest in the actual deal itself is going to need to be a personal guarantor on the actual debt itself. So if you think that, hey, you're looking to partner with a passive individual or passive investor that's going to have 50% of your deal, right? 50% of ownership of the deal. They're putting they're getting providing all the cash for the deal. And you do not want to be surprised when the bank wants to start asking for their personal financial statement and running their credit and that sort of thing. When this individual was like, hey, I'm okay, well, not okay, but losing all of my money and putting in this deal, I just don't want to be on the hook for more than that. Okay. So this can trigger a personal guarantor. And when you're midstream in a deal, you have it under contract, this is not something you want to be surprised with in the 11th hour. Okay. So you do not want, if they're going to be over 19% membership interest in the deal, they're going to have to open up their kimono to the bank as well. So before you move on to your sources of capital, any questions on the bank side of things before we start moving on? Okay. All right, we'll keep moving on. All right, so we talked about bank capital. We'll talk about your capital. Okay. Yes, we raise 100% of the capital for all of our deals that we do with our development company. Okay. But the reason why your capital is going to be important is because banks will look at, when you start getting into larger and larger deals, banks will start being more scrutinizing on your balance sheet, and not so much on the deal, right? When you're flying under the radar, doing your first couple of deals, it might be, your first, $3 million worth of deals. Your lender is going to looking more at the deal and less on you as a guarantor. Okay. But if the objective is to grow, you want to be conscious of what your balance sheet looks like, so that you can grow and not have your own balance sheet being a limiting factor in that, right? So my recommendation is always, when I onboard a client, for instance, that I have an engagement with, is employing what I call the CBSO program, or the continuous balance sheet optimization program, right? So if you own, and backing up a little bit because this may not be clear, your balance sheet, typically banks, when you start to get above a certain level, want you to have a net worth equivalent to what your loan amount is going to be. Okay. Now, this is not when you're buying your first couple $1 million of deals, but when you start to exceed that. And also, they're going to want to see that you have the liquidity on your balance sheet in either cash or cash equivalents. Cash equivalents being like other investments or liquid investments like stocks, bonds, mutual funds, and ETFs, is equivalent to what the down payment's going to be on the property, and also some reserves in the back end. Okay. So because they don't want you to, blow your entire liquidity, put it into a deal, and then if something goes sideways, then you have nothing within which to fall back on, right? So you want to be conscious in structuring your balance sheet to be as strong as possible, so that you do not have to have a personal guarantor on the debt with you to strengthen your global balance sheet between the ownership interests, right? Because my objective with my clients is that for them to keep most, if not all, of the equity in the deals they do. And that way they're able to do that and have maximum financial impact with every commercial deal they do is by maintaining a fortress balance sheet, or as fortress-like as they can possibly create, right? So if you have high equity properties, I don't care what the interest rate is. If you got 2% 2% interest rate debt on a single family home, and rates are 7% right now, and you have $150,000 worth of equity in that property, refinance it, take the cash out. Now, that may seem counterintuitive, but the thing is that property, yes, you got into the 6% club, which is, only 6% of Americans own investment real estate. That property does not serve you anymore. when it comes to the actual long-term game plan of being able to buy bigger deals. Okay. So it may cash flow you $500 a month. Big deal. You're looking to create, to acquire assets that are going to pay you 50, 75, $100,000 a year in cash flow. So if you have to, sacrifice that minuscule amount of cash flow in order for the big picture, then do it, even though you're paying a higher interest rate. Okay. So refinance, pull the cash of those properties and stick it on your balance sheet. That's going to strengthen your liquidity position with your lenders, right? If you have high equity in your home, get a HELOC. All right. Uh, Local credit unions love home equity lines of credit. Okay. So you can actually take the equity in your home, get a line of credit on that property. You can write checks off of that equity. And that is a enormously great credit facility, flexible credit facility to use if things go sideways on a deal in the future, that you have a substantial line of credit at your disposal to tap into if you need to. And it does not cost you a thing. Okay. You only pay on it if you draw off it, right? If you pull it, write a $10,000 check out of it, yeah, you're gonna have a monthly payment associated with that. But if you're a zero balance on that HELOC, then you don't have that. You don't have that, right? The third thing is, if you have an LLC, you can open up a 0% interest business credit card and start, and what I do and what I advise clients on is, especially if you have an LLC that's been formed 2 years ago or more, then you can actually open up a 0% interest business credit card. And I've actually used these 0% interest credit cards to actually fund earnest money deposits on deals I have under contract, right? And they're usually 0% interest for an entire year or sometimes 18 months. US Bank has an actual business credit card, which will be 0% interest for 18 months. So you can actually use this as a credit facility. Now, what I do to actually increase the credit worthiness of that business is that I will run all of my expenses through that credit card and then pay them off at the end of the month. And I'm talking about my personal expenditures as well. Okay. So, and generally what I'll have two different credit cards, right? So the one that I use is, if I'm not using a lot for the business, I'll have one business credit card that I'll run my personal expenses through. So that I know that, all right, I can't deduct these off my taxes, right? And so what I can do is that I can show the actual bank and their algorithm that I'm using the credit card a lot and I'm paying the balance off, using a lot, paying the balance off. And even if you're running the balance up to 100% utilization rate and then paying it off, this is not going to show on your personal FICO credit report, because it's in a business credit card with an LLC, not you personally. So this is how I've been able to actually create these flexible credit facilities by, sometimes I might open up a business credit card and I have a, $25,000 limit. And when I use this method and run all those expenses through there, then the bank will automatically increase my credit limit over time. So I have several credit cards that, are between, I think I did a count the other day. I have about $350,000 worth of actual business credit that I can use. This is really important as a flexible credit facility to help you out through the future. And that starts now. Okay. Because try opening up a business credit card when you actually need it, and you're not going to have the balance that you want that's actually going to make any substantial impact. So that's a little trick there in terms of how to optimize your balance sheet and also your credit facilities as well. The fourth thing is, if you have non-retirement investment accounts, okay, this is like, I'm not talking about assets that are in an IRA or a 401k or anything like that. If you have like an actual standard brokerage account, okay, you can open up what's called an S block or a securities backed line of credit with your broker, and sometimes for up to 80% loan to value as to what the securities are in there. So if you have $100,000 worth of investments in a S&P 500 index fund, then you can get a line of credit that's up to 80% loan to value based upon those assets. Having that actually as a credit facility for the future as well. So all this is you're building and positioning yourself to be as flexible as possible, keeping your balance sheet strong, and then also also having the flexibility within which to draw on if unexpected things happen. Now, God forbid, there's a lot of these credit facilities I've never had to touch my home equity line of credit ever for a business. But it's always nice to have if things do go sideways, especially right now I'm in development projects. And there's a lot of things that can go wrong with those. So The last thing is that if you have retirement accounts, now you can convert them to what's called a self-directed IRA. I saw something the other day where there is about I think between 11 and 14 trillion dollars worth of money that's sitting in individual retirement accounts or IRAs in this country. You can convert some or all of your IRA to what's called a self-directed IRA, where you're not constrained to just the stuff that marketable securities to invest in. So you can use a self-directed IRA to invest passively in real estate, to lend. You can do like private lending. You can do hard money lending. Doing private mortgages with those funds, and a lot of other alternative investments that are at your disposal rather than just the regular marketable securities. Now, there's a self-directed IRA custodian that I use, which is called Equity Trust. If I don't have an alternative investment within to push those funds, you can also have marketable securities and hold them in your self-directed IRA. So if you have a S&P 500 index fund that you really like a lot, you can have those funds held within the custodian with your self-directed IRA, right? But you have the flexibility to be able to, let's say, if sell half of those and use some of that money to, let's say, do some lending out of, or other types of alternative ventures, right? So you're not scrambling at the last minute to try to convert your IRA that's held with, like, let's say, Wells Fargo, for instance, to a self-directed IRA, because it does take about a week or so in order to do that. Anything else on your capital? Let's see here. I got a question in the chat. So John asked a question: do you find the fees associated with your self-directed IRA to be hurting your overall objective? Okay. So this is a great question, because typically with a self-directed IRA, whether you use it or not, there's typically an annual custodial fee that you'd have to pay a company like Equity Trust, which I think is about $350 a year, flat fee. Okay. So if you have $10,000 in a self-directed IRA, that can be cost prohibitive, right? But what I'm going to get to next is on other sources of capital. The reason why I recommend all of you to do these things is because when you do them, you open up a self-directed IRA, you can talk more intelligently about these types of vehicles and cash resources to other investors when you're raising capital in the future. Okay. So it may be cost prohibitive to have $10,000 in a self-directed IRA that you have to pay $350 a year or two in custodial fees. But if you can speak from a position of experience to another potential investor that has a $800,000 IRA and you're raising $300,000, you can say, yeah, I did this. It was extremely easy. You can invest in other things outside of it, instead of being from a position of, oh, I heard of this thing called a self-directed IRA. I don't really know much about it. I haven't done it myself. It just adds a lot more to your credibility factor in the process. But that's a great question, John. Any other questions? I want to make sure that we're taking breaks here, so I'm not going too fast. Okay. Because you all are pretty quiet today, I'm going to invite it. If you have a question that pops in your head, just unmute yourself and pop in. I'll answer that question. So I was expecting probably about 40 some odd people today. We got about an intimate group of about 7 people today, I think, including myself. So by all means, if you have a question, just shout it out.
Hey, Matt, may I ask the question?
Yes, absolutely. Go ahead.
Hello, everyone. My name's Antonu. So my question is, what if you already have a line of credit? I currently have my line of credit at ESL.
Mhm.
It's sitting there. Now I'm like, what is the next step? So that's where I'm at.
Okay. And then what type of line of credit is this?
It came from my business. So I grew my business. Then they came to me, said, "Hey, your business is doing well. What about open up a line of credit? It's collateralized through my business." So
Mhm.
now it's just sitting there, and I would like to use it for real estate, but got to this point, but don't know where to go from here.
Okay. All right. Sounds good. So one thing is that it just depends. How long have you had this line of credit open for?
About 2 years now. So I
But
grew up from 25,000 to where it is now, over a 2 year period.
okay. And where is it right now in terms of your limit?
Uh, you said what the credit limit is?
Yeah, right now.
85,000.
So 85,000. So one of the things that I do occasionally too, and don't do this too much, is on my lines of credit, I'll go back to the bank and say, "Hey, I've been using this. I've been paying on it. I'd like to get an increase in the actual line." All right. And a lot of times they'll do this. They may run your credit again to do that, but just being able to grow that line and having that as a backup tool for you is going to be very important. Because what happens with when you're acquiring your first larger deal, okay, your first larger deal, and I know that Nick Canute is in here and is looking to acquire commercial real estate and that sort of thing. First deal takes so much time and energy to actually, get a deal under contract, that all the frogs you kissed, all the deals you made offers on that went nowhere, all this, energy you deposited out in the universe ends up turning into your second, third, fourth, and fifth deal happening in rapid succession to that first one. All right. And, in my life, tragedy never happens at a convenient time, neither does opportunity. So all of this is about really structuring your capital base right now and then growing that so you have as much liquidity and tools within your arsenal to do that. Anton, did that answer your question?
Yes. My only, I guess the second part would be, do you use the line of credit as the down payment for a property, or do you use other money that you have?
So we're gonna actually go into that. My objective is to raise the capital from other people, OPM, on every deal that I do. Okay.
Got it. Got it.
Because I want to maintain my own balance sheet as strong as humanly possible. So I only have these credit facilities when things go sideways. So like, let's say I'm raising, so John just put in here, how do I acquire 100 plus unit property for $9.5 million? Okay. So if there's a $9.5 million property and you got to raise $2 million for it, you get to the 11th hour and you have gotten, you've raised and gotten committed $1.5 million of the $2 million you need to raise. And you're like, you're past due diligence, your earnest money deposit now is non-refundable, then now you have, okay, hey, I didn't want to touch that line of credit, but I'm going to have to bring this deal across the finish line because I know it's a great deal. Okay. This is the reason for that. You do not want to be scrambling. Like if you're at the 11th hour on this 100 plus unit deal, you don't want to be scrambling for all this stuff at the last minute if you're not going to prevail. But if you've done all the preparatory work, all the strategy type of stuff in the beginning to position yourself, then you're going to have a much higher probability of being victorious in the process. So John asked, how do I acquire a 100 plus unit apartment deal? I'm assuming for $9.5 million. John, can you kind of jump in here and kind of clarify that question?
Correct.
Okay, yeah, talk to me about that.
It's a deal that's up on LoopNet. It's been up for quite a while. Really no one's touched it, so I'm kind of looking at it. It's about an hour south of me, but it's 9.5 million. The rates are around $1,100 a month per unit, so cash flow wise it meets the criteria, but I'm like, the problem is I'm looking for a mentor to kind of help me with that, because I want somebody who's been through this, that other than me is, wet behind the ears. I'm like, I want somebody that knows where to kick the tires, where to look for, where, what am I missing that I don't know enough to ask, and etc.
Yes, absolutely. And we'll get to that on the actual deal flow side of things within this webinar. But generally speaking, Lexi and LoopNet are, generally speaking, I'm gonna say, because I've bought deals off of LoopNet. Actually, I bought that Port Exchange building off of LoopNet, by the way, is where commercial real estate deals go to die. They are the trash bin of commercial real estate deals, right? Because generally speaking, when a broker gets a listing agreement signed, a commercial broker, they don't drop that listing immediately onto Crexi and LoopNet, right? Commercial real estate brokers have a very, very high degree, I'd say, obsession over controlling the outcome of transaction, because commercial brokers don't do a lot. It's not a high volume business. They may do one to maybe three bigger deals a year. Okay. So if there's a deal that falls apart because some schmagag out of town gets one of their listings under contract, and that deal falls apart because they weren't able to perform, that broker may not, they may not eat. Okay. They may not be able to put food on the table. So they generally, when they get a listing agreement signed, they're going to go to like their A, B, and C list, right? Their A list is people that they've already done deals with before, that they know, like, and trust, that they have the track record, the ability to perform. Their B list may be people that have called them on deals before, they've met with them for coffee and lunch, have a fair degree of confidence and that know, like, and trust factor with that particular investor. The C list might be, all right, if they exhausted A and B, they may be going out to other brokers and asking them, "Hey, I'm bringing out a 100-unit deal to market in a couple weeks. Do you have any clients looking for a property like this?" Right. So after they've exhausted the A, B, and C list, then they drop it onto LoopNet and Crexi, and that's it. And that's why you'll see listings out there just get stale, right, and go nowhere, because everybody that's in the know, that's savvy, has the ability to perform, they've already looked at it, and it's trash, right? Usually it's trash because either very bad location or it's extremely overpriced. And I'm not talking about overpriced from the standpoint of like a couple $100,000 overpriced. It's sometimes millions of dollars worth of overpriced. But I'm happy to talk about my strategy and how I've actually gotten great deals off of LoopNet. But we may not have enough time for that today. But that's the reason why it's probably there.
Thank you.
So yes, absolutely. So let's talk about OPM capital, right? So other people's money. We talk about your capital, your balance sheet. We talked about the bank capital, OPM capital. This is I'm going to harp on this. I'd already talked about it before. This is where this starts now, and because, like I said before, relationships move at the speed of trust. All right, you may see things out there, sponsored ads for, for syndications, right? So, we'll teach you how to syndicate equity for 100-unit apartment deals and that sort of thing. Okay. And they're usually going to say, don't worry about the money. The money will come. Just find the deal. All right. Which I said, is a myth that deserves to be killed. There is a high degree of probability, 99% sure, that if you're using OPM, that the people are going to put money into your first deal or the first bigger deal or raising capital is probably going to be somebody that's in your sphere of influence, that knows, likes, and trusts you. Okay. So this is the reason why it's incredibly important to start working your sphere of influence now. All right. And letting them know, hey, I bought some investment property in the past. I'm looking to take my real estate business into a new chapter. This is what I'm looking to do or accomplish this year. This is a great time of the year to talk about it. You're going to see people that are in your family, friends, coworkers that are at holiday parties, where you're going to be able to tell them this new chapter you're embarking upon. Okay. And then also I have some clients that actually two clients I'm thinking about that are, like, Matt, all of my family is flat out either broke or dead. All right. Then if you're the richest person in the room, you got to change your room. All right. So I'm serious. Okay. It sounds harsh, but you're not going to get capital for your deal from some stranger off of the internet. It's just not going to happen. All right. All of those crowdfunding sites you see, like Realty Mogul and Fundrise and all these other ones here, that you just post your deal up there and you're magically going to get all the capital you need to close your deal, it's complete nonsense. Okay. And we're seeing the result of that through a lot of distress that we're seeing in the commercial real estate market, especially as it pertains to multifamily and other areas of the country. So this is what I suggest, right? Utilizing the 1-1-2-3 method. I have this more detailed on my YouTube channel. But this is essentially like social blockchain and consensus building, right? So the first step is, spreading the word about your next chapter, right? Especially if you have some background and experience in doing smaller deals, spreading the word to your network. Okay. I love to use social media for this. By the way, I never used social media before. My mentor was like, Matt, you need a thought leadership platform. This is like the best marketing tool you could possibly do to touch thousands of people a week and indoctrinate them into the idea that Matt is in real estate and he's good at it. Right. I was very hesitant to this whole thing because I was like, I don't want to put my business life out there. People don't want to hear about that. They're going to think I'm like money hungry and greedy. And this is the only thing I think about and that sort of thing. But he really, really changed my mind. And this guy is by the name of his name is Joe Fairless. And, his company, Ashcroft Capital, owns billions of dollars worth of apartment assets across the country. So what I mean to say here is social media is to be used for one thing and one thing only, and that's business. Okay. Even though Facebook seems like it's a social place, you can document your journey on what you do on a day-to-day basis as a landlord, for instance, how you screen tenants, how you, even all this, inane type of stuff of like the importance of fall cleanup before winter at your property. You, especially if you own real estate right now, you are in a very, very enviable position within people in your sphere. Everybody wants to own real estate. Okay. But a lot of times the reason why they don't is because of the 4 T's, the tenants, trash, toilets, and most importantly, time. So using social media to indoctrinate your sphere over time as a subject matter expert, for instance, is going to be really helpful with when you meet somebody for the first time that you're connected with in either Facebook, Instagram, or LinkedIn, for instance. I don't care which platform you use. That first interaction with that person you're meeting for the first time is going to be very highly leveraged. Okay, assuming that you're connected with them already. The second time you meet them after they've been, witness to your content. This is the reason why I post every single day. Actually, 6 days a week is how much I post, is because I've seen the magic of this happen. Right. Quick story. Several years ago, I was walking on the canal with my wife, and I had heard this guy in the background, and he was like, Matt, how's it going? And I turned around, and it was this guy I went to college with that I hadn't seen or even thought of in 10 years. And the guy was like, hey, how's it going? I follow your stuff. Like, I'd love to talk to you about real estate sometime. I barely even recognized this guy, but I've been connected with him on LinkedIn through college. I mean, think of like LinkedIn was like, when you put your resume out there to look for jobs, like that's how long ago this was. And so having that very highly leveraged interaction is really, really a game changer. And if you could think about how that can compound over time as you're building your capital base is really, really important. So in regard to content on social media, you may be a very private person. You may be completely resistant to this whole thing, but here's the three tests of value with what to post in regard to your real estate business, for instance, is if it doesn't entertain, if it doesn't educate, and it doesn't inspire, then it doesn't belong in your feed. All right. So, and the thing is that once you start doing this more and more, being more intentional about your content around the subject matter expertise, the easier it'll get in terms of generating content ideas and that sort of thing. I go way more into that training on my YouTube channel. I'm not going to spend too much time on it right now because I know we have less than a half an hour left. And then other things, never eat lunch alone. Always be meeting people. Always be, if you haven't seen somebody that's a good friend in a while, get lunch with them, get coffee with them, get a drink with them, get dinner with them. Whatever you have to do to cultivate and maintain those relationships is really, really of paramount importance, because there's nothing that I talk about social media, but there's nothing that can replace actually one-on-one belly-to-belly interaction, right? You can get through trade, going to industry trade associations, regardless of whether the industry. It could be a real estate trade association, or if you're in if you're in quality control for Procter and Gamble, and there's a society of quality control professionals, industry trade association. Join that trade association and give value to that organization to build those relationships. For instance, all right. This is how to fill your calendar. All right. And now this is I actually block off time each week to fill my calendar with lunches and coffees and meetings. Right. So I said about an hour a week where I'll spend, and I'll just dial and, and go through my contact list and with people that I haven't touched base with in a while. And that's how I'll actually fill up my calendar with these interactions. Right. And so this is incredibly important to augment the two of those. Also, another quick trick that comes to mind too, and this is what I do. I drive around a lot, around town, whether it's like taking my kids to daycare and that sort of thing. So I spend about like an hour a day in my car. If I think of somebody while I'm driving the car, I'm calling them. All right. Even if the idea pops in my head, I'm thinking of uh Atna. I'm like gonna be like, okay, I'm calling him, right? And so this is one thing is like I kind of refer to as like the Holy Spirit, so to speak. So, and I'll call that person, hey, how's it going? I thought of you. I thought of you is like a magic phrase, right? Because people want to be seen and want to be heard, right? And that, generally people, getting the KLT factor, the know, like, and trust factor, is really predicated upon being a likable person, and being likable is actually taking an interest in people, right? So, hey, I thought about you the other day. Um, it's been it's been a while since we caught up. Like, how, like, you want to get together for coffee or lunch? And if they say yes, which assuming they will, like, all right, great. I'm driving right now. I don't have my calendar with me, but can you text me like 3 dates or time blocks that might work for you to get together for coffee and lunch? So that when I stop, I can actually, we can get something locked in. Like, this is what I do, right? Because I don't want to be driving around like, pulling up my calendar, that sort of thing. So I knock the ball out of my court into theirs, and then they send me a text with with a few dates that work for them, and then that's how I lock something in. So that's like a quick, slick trick in terms of how you can utilize your downtime. um Continued on OPM. If people ever want to pick your brain about real estate, let them. Okay. I used to actually be resistant to this because I got sick of it, but because I was like, how is that going to help me? Right. With somebody picking my brain. And things kind of shifted, and I was like, okay, well, because I would take these meetings eventually, and like I said, there's only 6% of people that own investment property in this country. All right. So they do want to have some sort of access to it. So if you have the chance when you meet with somebody who's interested in talking about real estate and picking your brain, so to speak, you have the opportunity to demonstrate your subject matter expertise with that individual. All right. And so how I go through is like, and this is when I'm even at a industry party or a work party and that sort of thing. I always ask, have you ever thought about buying an investment property? Right. And I go through the standpoint of trying to talk through it and how they can do it themselves. Right. And going back to your own capital sources, for instance, I talk through all those ways in which I fund real estate myself. This is what plants the seeds in terms of how they can actually build their own capital base, with fully knowing that 94% of the people you talk to are never going to buy a real estate deal. But if you can help them get in the position to do that, then they can be a great passive investment partner by doing that through the education process and genuinely wanting to help them do that. Not with the idea of like, hey, maybe I can convert this person to an investor. Really, really authentically come through the standpoint of trying to help them do that, right? This discovery process of people that I meet with that are looking to pick my brain, or even investors that might be interested in passively investing in my deals, is on a real estate deal, what would be your priority if you had to pick one, cash flow or equity? Okay. The reason why this question is important is because a lot of investors look at real estate as cash flow. All right. I don't care about cash flow, to be honest with you. I care about the long-term equity and appreciation that I can get on buying a $10 million asset, how much debt I can pay down each year. And even if rents appreciate organically 2 to 3% per year, and how much of a game changer that has for my net worth, and being able to, increase that value of that property by a lot. So I don't really care about cash flow. What I like to do is I like to marry an individual's desire for cash flow with my desire for equity appreciation. All right. So if they say cash flow, then I always ask them, well, would you prefer to, if you were to invest in a deal, would you rather get a guaranteed rate of return, or would you want upside if you had to pick one? Okay, if you only had one choice, you'll be surprised at those people that are very, very obsessed with cash flow and don't care about the tax benefits or the appreciation or the debt pay down, which are the other three benefits of real estate. Then that is a great private money lender that will, and you can borrow money from, personally guarantee it, okay, and then be able to pay them a fixed rate of return. And this is how I actually have most of our investors structured. Okay, I know that Brian actually asked. Let me look in the chat here to see what. Okay, so Brian's rookie question is: when raising capital, how do you structure paying back investors when it comes to the investor committing to send their funds to a trusted attorney, or how does it work to fund for fund distribution? Okay. So generally the structure is based depending upon interest rate environment. Okay. There was 5 years ago when interest rates were like nothing. I was paying investors 7% fixed rate of return, personally guaranteed by me and all of my company assets. All right. Fast forward to now, you can get a FDIC insured 4.75% in a money market account, right? So 7% doesn't look that attractive when compared to the risk-free rate of return. So what I do now is I have to adjust that, right? So generally what I'm offering out is like 10% fixed rate of return guaranteed by me and also all of our all of our properties to that investor. Okay. The second part of the question is, do they send their funds to a trusted attorney? Okay. So generally what I do, and I actually have, more trainings on this on the actual order of operations from contract to closing on my YouTube channel. But generally what I'll do is that if it's somebody that I am really close with and I know will perform with me if they verbally commit to like, yeah, I'm good with putting $200,000 into this or $50,000 into this, is that I will say, okay, great. I'll have the attorney draw up the promissory note documents and that sort of thing, and the security interest documents. And once we get this deal further down the line, I'll execute those, send it over to you, and give you my attorney's wiring instructions. Okay. If it's somebody that I don't have a working relationship with and don't have a very, very high comfort level with, and I'm getting close to, being like halfway through due diligence or close to the end of due diligence, I'm going to instruct them, hey, I have the promissory note documents that I'll, execute with my attorney. And then just so I know you're committed, you wire your funds into our attorney's IOLA trust account, which is held in escrow. And then those funds will be dispersed. And then we'll start paying interest to you after we close. Right. If the deal falls through, if we don't get our bank financing, if whatever, then your funds will be wired back to you. Okay. The important thing about having this into an attorney's account is one is, attorneys, doctors, engineers are some of the most revered, maybe not attorney, maybe not attorneys, but they do have a high degree of, especially, reputable ones. You don't want to be using an attorney that works out of their basement. Right. But those attorneys, we work with a law firm called Davidson Fink. They're kind of like a white shoe law firm, for instance. So there's a high degree of trust factor there. So that is like, hey, I'm not taking your hey Nick, did you have something to ask?
Nope.
Okay. So that's what I do generally. Brian, does that answer your question? And did you have a follow-up question to that?
Yes, it answers it. I appreciate it.
Okay, cool. All right, cool. So the last question I asked is that, after this brain picking session is that if I had a deal that I really liked a lot, would you like to hear about how you could participate? 99% of the people say yes. All right. Yeah, I'd love to hear about it. Sure. No commitment. This is the reason why it's very important to start right now on the capital portion of things is that the beautiful thing about raising capital when you don't need it is there's no pressure. There's no pressure. All you're doing is you're planting seeds out there into the universe across your sphere of influence, and this will make the capital raising part a lot easier when you actually get a deal under contract. I guarantee it. The last form of capital is seller capital, right? There's a lot of people that are sitting on the sidelines right now that, interest rates are high, prices haven't come down enough, nothing makes sense. I love high interest rate environments because a lot of my competition, they just go away. All right. Because nothing makes sense. There's interest rates are high. Creative financing becomes very, very prevalent in high interest rate environments. Right. There's sellers that need to get deals done. May not be at a price you want to buy it for, but seller financing allows you to actually give them what they want if they're willing to get creative enough. Okay. Quick story. There was a 18 unit apartment deal that was representing on a as a broker when I did brokerage. I don't do brokerage anymore, but the seller was at 1.8 million, the buyer was at 1.7 million. All right. And there was no budging either way. All right. The seller said, I'm not going to do 1.7. I'm not a seller, but I'm willing to get creative to get to 1.8. So what the seller ended up doing is or the buyer said, well, how about you hold $100,000 as a second position mortgage at 0% interest, zero payments for 5 years with a balloon at the end of 5 years. And the seller said yes. The deal happened, right? So that blended the buyer's cost of capital down significantly by doing that, right? So seller financing is a capital source to understanding the benefits of it first. Okay. And this is when you're directly negotiating with a seller itself, right? Themselves. On the seller side of things, the benefits is if you got bank financing and they got 100% cash, what are they going to do with the money? Right. With seller financing, they can actually get a predictable stream of income, right? That's collateralized by an asset, and also, typically, which we do, is we personally guarantee that as well. So they have an asset that they're already familiar with. They've operated, like, let's say, for 15 to 25 years, and then also with an operator that has a personal guarantee on it as well. Things go sideways, right? The other thing that's very understated is the tax benefits for a seller. Tax benefits, it gets structured as an installment sale when the seller holds the mortgage. So if you were to give them 100% cash at closing and they've held the property for, like, let's say 30 years, and they've fully depreciated that property down to zero, right? And they're selling it for $2 million, they're going to have a capital gain of $2 million, right? You can lessen that blow to them if they actually hold the mortgage. And by the way, the less you put down, the less they capital gains they have to pay when they sell the deal. So this is how we've actually been able to do seller finance deals with 5% down. And the reason why they've been agreeable to that is because, hey, I only pay capital gains on that 5%. And then the rest of it, I get structured as an installment sale that, based upon the amortization schedule and whatever loan terms we agree to, it gets structured, and I get to pay my capital gains in increments over time. All right. The other benefit too is because it's totally customizable. If you structure it as interest only payments for the first 5 years, and there's nothing that's going down in terms of the principal, then they're just paying ordinary income on on those interest payments, not not on the portion of the debt pay down. So being savvy with this, on going through the discovery process with the seller, or or the seller's broker. And I'm going to go real quick later on, because I'm actually running out of time. I think we have until 1:30. We're not going to be able to get through the entire thing. We can actually schedule a part two. But this is really important stuff I want to definitely dive into. If you have a gatekeeper, which is the broker, okay, I'm sorry. I'm sorry if there's brokers here, but you're the gatekeeper between the buyer and the seller. A unique strategy that I've employed and that my clients employ on how to get seller financing passed through the gatekeeper to the actual seller themselves. Okay, so I'll cover that in about 5 to 10 minutes. All right. The benefit to you, the buyer, right? It can lower your cost of capital, right? So if there's interest rates that are 7%, and you're negotiating a seller finance deal that's 4.5%, 5% interest, then you can lower your cost of capital. Now, you may pay more to give the seller their price in the process, but because you're willing to compensate them to have a lower cost of capital. All right. The other advantage too, sellers holding the mortgage, you're not dealing with the banks. Okay. Banks can be a nightmare. Okay. I spend a lot of time with my clients on when they getting properties, when they get them under contract, through to the closing table, and all of the chicken dance that banks make you do to get the property to the actual closing table is where a lot of my time is spent with my clients. But you don't have to deal with the banks when it's a seller finance mortgage. Okay. And the great thing too, after you execute the business plan, assuming this is a value add deal, like a building you buy for $1 million and push it to $2 million worth of valuation based upon your increase in the actual value of that business asset. Remember, this is a business, not even the real estate business. And you pay them off. I've converted property owners to actual investment partners of mine, because I perform for them. It's a great case study and a way to actually develop a relationship and proven track record. And oh, by the way, nothing keeps you top of mind more as a credible, proven operator than them getting love letters every single month in the form of mortgage payments from you. Great way to keep top of mind, right? People sending you money. So here's some caveats around seller financing. Getting through the great gatekeeper, right? The broker. I can pick on brokers because I used to be one. Sorry, Nick. Is the 3 LOI strategy. Okay. Typically, when you go to a broker and you say, would the seller be willing to hold a mortgage on the property? Okay. Generally what a broker is going to say is they're going to say, no, they want all cash. A lot of brokers, I think every broker in the world, besides, besides Nick and myself, don't really understand the advantages of seller financing. So what I do to get past the gatekeeper is that when I meet with my clients to actually discuss a deal and what our strategy is going to be on a negotiation strategy, is that we'll submit 2 to 3 LOIs, or what's also called letters of intent, right? One will be 100% cash, right? We're getting bank financing. You're just going to get a lump sum of cash at closing, Mr. or Mrs. Seller. Second one is going to be, hey, we'll pay you this price, well, more than the cash price, but we want you to hold 95% of the paper, okay? At a certain percentage interest rate, right? And the third one, what I'll do is that, okay, well, if you're asking me $1 million, how about if you get $800,000 at closing, then my bank is going to give you, and then you hold back a small second position mortgage for $200,000. All right. So they're getting more lump sum up front. They're getting some tax advantages with being able to delay some of the capital gains on $200,000, right? So what this ends up doing is, generally speaking, broker is going to, now residential is a little bit different than commercial, but a broker generally will present this to the seller. It's like, hey, there's this guy, he's got 3 different proposals. This is the cash deal. This is the other 2 there. So this will get the juices flowing in the seller's mind that you are looking to collaborate with them to give you both which each other want. All right. So now they may not go through for any 3 of those options, right? But they may say, all right, well, I really don't want to hold that much in a second position, but I'll hold $100,000, right? Like if I get most of my money at most of my money at closing. So this is what is the magic of this is that you kind of get these different anchor points around the negotiation, all the levers you can pull in structuring a successful transaction. Okay. The caveats on this is that in the case of a seller second, where you're bringing in a bank financing, really understand what the bank, how much the bank is comfortable with that, right? So generally speaking, there's actually a deal, a 58 unit deal that one of my clients has under contract. It's an apartment deal where they're buying it for 2.4 million, and the seller is holding, I think, $300,000 in the form of a seller second position on the mortgage. Being very clear up front with the bank is that, are you cool with that? All right. Because it's possible that you can actually have whatever the down payment is structured in the form of a seller second, right? So you don't have any down payment associated with it. But if the bank isn't cool with it, then it's not going to go anywhere. And you really don't want to be scrambling and being blindsided mid transaction with your bank is not cool with second, seller second mortgage. So you want to understand that right in the beginning, right? Because a lot of banks want to see some sort of like skin in the game or risk capital, so to speak. 2 is additional financing allowed, right? So there's things called DSCR covenants. They're debt service coverage ratio covenants that banks have. The banks in the commercial side of things, you can break even on 1 through 4 family, residential deals that are funded with residential Fannie Freddie mortgages, and they don't care. Okay. With commercial financing, the bank actually requires you to make money. All right. So generally speaking, they want to see a debt service coverage ratio of 1.2 or 1.25. So they want you to make a margin above which your break-even point of 20 to 25% above that in order to be comfortable with the actual loan. If you're taking too much seller financing and you're adding debt on that property and it negatively influences DSCR, then the bank may not be comfortable with that. Okay. But you may need to bring additional cash to the table. But if you have a seller second that's at substantial discount to what the bank's interest rate is, you're still blending the cost of capital down, but you want to be aware of that going into it, right? Also, terms in alignment with bank financing. So the seller is willing to hold a second for 10 years, but your bank has a balloon in 5 years. That may not work. Okay. So you may have to have those terms be coterminous with each other on that. Any questions so far? Because I think what's going to happen is I'm going to run out of time here. And The reason why I actually blacked this out to my email list and also my social media contacts was to actually time myself. And I was actually able to get this done, the whole thing done in an hour and a half. But apparently I'm not able to do that. All right. So we got about 5 minutes left. I do want to go now. I'm gonna gloss over this very quickly. A lot of people, the reason why they think that they can't get into commercial is because there's all this terminology I don't understand. I need to know how to underwrite deals. I don't know how to underwrite commercial deals, all that stuff, right? The underwriting and the mechanical components of the lingo is the easiest part of this whole thing. It's in the capital stack put together, and finding the deal is those are the two most challenging parts of the entire process. So I'm actually just going to breeze through this because there's a ton of YouTube content on the knowledge and terminology and that sort of thing that I just don't think it's going to be as high value to give you today. So all right, I'm going to go through here. All right, so deal flow. I have a step-by-step process, but before I start that, deal flow is it's like priming a pump. Okay. There isn't deals that just come off, like the MLS with the residential properties, that they just come off. You get an auto email from your real estate agent and, you go look at a property and that sort of thing. The deal flow is formed through relationships and follow up and nurturing those relationships with my favorite deal channel is through commercial real estate brokers, because you have all these people within your community that they're the bread on their table depends upon them making transactions happen. Okay. So you can leverage this network of people that's their sole job is to make transactions happen to get you deal flow off market and on market. Okay. So this is a step-by-step process for this. Like I said before, is that the commercial real estate brokerage transaction space is very fragmented. So this is how you can take advantage of that market inefficiency and put in your favor. Okay. Step one, just like John had done, combing through LoopNet and Crexy, find those garbage bin real estate deals, find the active brokers that are out there and call them. Okay. And ask about the property. Okay. It may not be your cup of tea, but this is actually a relationship of somebody that's actually active in that transaction space that you can start forming a relationship with. All right. If there are no deals in your market that meet your criteria, okay, this is a slick trick. You can contact that LoopNet sales rep. Okay, there's one that's generally assigned to any given region, for instance. Call the LoopNet sales rep and say, who are the active brokers in multifamily in this market? And they'll give them all to you. Okay. Um, Nick and I are Pat Wayne is a local market rep for Rochester. Okay. So this guy's going to know where, who the players are, so you can get in touch with them, right? If there's nothing that's on the market that you can find through these websites, right? If they have a property that's even in somewhat alignment with your criteria, if it's like not the perfect one, schedule a tour if it's to walk the property. Okay. The reason why this is important is because sometimes you're helping the actual broker. If it's on LoopNet and Crexy, it's not moving. Okay. So if you can give the broker some feedback, and also the broker can say, hey, I had a tour last week. This is the first tour I've had in 2 months. This can actually help them save that listing by, because a lot of times clients, and I've been a broker before, it's like, hey, broker, you're not doing anything. All right. So you're actually helping them by doing this, right? And then schedule a tour after getting the actual offering memorandum on the property. You don't want to go there before actually having some preliminary homework. Offering memorandum is basically high level. This is the property. This is the unit mix. They may have some rent roll and financials and that sort of thing. Some high level stuff there, so you can be more intelligent with what questions you ask to that broker when you're walking in. Okay. Now, traditionally speaking, a lot of residential investors, when they're dealing with residential properties, they're going to expect to walk every single unit. All right. That is not the case with commercial. All right. So, yeah, Nick just agreed with the chat 100% on whatever I said in the previous to this. But you don't need to walk every single unit, right? So can I see some vacant units? Can I see some common areas and mechanical rooms? Okay. If you tell them, hey, I want to walk every single unit, unless it's a smaller deal, then you're gonna be seen as a noob. Okay. You walk the units when you go through due diligence, all of them, right? After you get the property under contract. Um, so the other important thing here is that analyze the deal and provide prompt feedback to the broker. Do not be a Casper. Okay. A lot of investors out there, they are aggressive about contacting the broker, getting the information, and then the broker sends over the confidentiality agreement or NDA. They sign, the buyer signs it back, sends it, they get the deal room, all the financials and all that sort of thing. And then they never even follow up with the broker and say, hey, I analyzed the property. This is the reason why it's not my cup of tea. And, so on and so forth, right? You will have a much better chance of getting off market deal flow through commercial brokers if when there's a volley, right? There's an action reaction to the actual relationship rather than I sent you a bunch of stuff and then you didn't even respond to it. And the button that gets pressed that has a reaction in this case is the one that gets pressed, which you want that to be you. Okay. When I send deals to them, they respond back to me. They have intelligent feedback on it. And, and that feels better than just being ghosted. And people do that. People used to do this all the time in the past. Okay. They're like a dog chasing a car. They wouldn't know what to do if they caught up with it. And then once I tell them, hey, this is the reason why it doesn't work, this is the reason why I like it. It's a great location, but this is the reason why I don't like it. And this is what I'm really looking for. This is my buy box. This is my criteria, being as specific as possible with that. And then you ask them, hey, anything else you got in the pipeline that might meet their criteria? Okay. A lot of times brokers can say, oh, I don't have anything coming up and that sort of thing, but always ask the question. Okay. Because you want to be somebody that's seen as like, hey, I'm actively looking. Okay. I'm not just kicking the tires out of here. If I find a deal that I like, that I'm going to buy and close on it. All right. So there's the last part of it. Then what I do is I schedule lunch or coffee with a broker, even if the listing is not my cup of tea, or if this is somebody you got off of your local CoStar, CoStar or LoopNet contact with the active brokers that are in multifamily or industrial investment sales. Schedule lunch or coffee with a broker, right? Brokers like to talk. They understand this is a relationship business. Most of them will take you up on it, right? And this allows you to get belly to belly with you to actually nurture and develop that relationship with them. Okay. And then the other thing I do is I time block time to call the brokers I have relationships with, right? And I will do that. I'll call them once a month and just check in with them. Hey, thought of you the other day. Remember, there's that phrase, I thought of you. What deals you're working on right now? And I like to talk about lease deals and also sales deals because brokers will actually do lease deals, will be like the consistent source of income that they have and putting lease deals together, and then also some sales, right? Are there any space? I have other real estate investors that are friends. You guys are you doing any tenant rep work, right? Tenant representation work. What spaces do you have available for a lease? I have a friend that has a hardware company looking for some retail space, whatever. Being that person that can have a conversation with them. You don't have to always be calling them up and saying, hey Nick, do you got a deal? Do you got my deal? It's like that's like talking to them like they're objectifying them. Okay. You don't want to be that person. All right. So and then I usually like to make it a point to get together with them for lunch or coffee at least twice a year, right? And then you rinse and repeat that with all your with all your contacts. So what this happens is that then this is how you prime that pump intentionally over time to get in front of deals. All right. I'm going to close that with some follow-up resources, and then I can field some additional questions and answers in the process. But the reason why I'm doing this, right? I actually forgot to mention that. I do have a business where I help residential investors go from residential to their first larger commercial real estate deal. Okay. My offer is I help you land your first larger deal. They'll add $300,000 to your net worth minimum, $30,000 a year in cash flow minimum, guaranteed, or I'll keep working with you for free until you accomplish the objective. Okay. If you're interested in learning about what that looks like and to see if we're both mutually right fit, schedule a 1-hour consult with me. Okay. I'll put a link in the chat here, but also I have a follow-up email going out after this with a link to my calendar. You can pick a date and time that is convenient for you. And then we can hop on a one-on-one and see if we're a good fit for each other. And at the very least, it should provide a immense amount of value to you, at least giving some direction with you and me hearing about your individual situation, right? Subscribe to my podcast. I interview real estate investors, commercial real estate investors every week and how they did their first big real estate deal. It's called the Go Big Live Real Estate Investors Podcast. So make sure to subscribe to that on wherever you get your podcast, whether it's Apple or YouTube. And then also subscribe to my YouTube channel, which I'll also have in a link, follow it up after this as well. So I know I went through that really quickly. I'm actually parched for thirst. Any follow-up questions you all have at all?
No questions, but thanks a lot, Matt. This was fantastic, as usual.
Okay. All right. So you got some value out of it?
Of course. Yep. Always.
Okay. Awesome. Yeah. And yeah, and also let's keep in touch. Any other questions you guys have?
Yes, I just have a quick question.
Yeah, absolutely.
What would be, I guess I would say, what would be the one thing, what would be the one thing you want us to do to move our future forward right after this meeting?
Yeah, I have it laid out. One thing is start working your network. If you're looking to scale into larger deals, that capital part of the thing is so incredibly important. It takes the most amount of time for somebody to give you a piece of their life. Okay. Because generally, when an investor invests money with you, even when they're lending it to you, that is money that they earned typically, and they saved up, right? And it took them time to do that. So if you and that takes a lot of trust, and
Right.
trust takes time, and trust takes time. That's the one thing I would focus on. And if you do not have anybody that's in your sphere that it could be a potential money partner with you, you got to change your sphere. You got to change it up.
Yes.
So that's what I would say would be like absolutely most critical.
Matt, I have a question. Which
Yes.
type of deal, I know everything's different, but is it easier for multifamily or is it easier for commercial? And if you're looking for commercial, should there already be tenants?
Okay. This is a great question. Okay. So multifamily in terms of asset class is the easiest to raise capital for, and it's the easiest to get financing on. Okay. But the trade-off is that there's a lot more competition. So that being said, I'm actually just gonna copy my calendar link here real quick and paste that in the chat. So that being said, yes, it is easier from that standpoint. Much harder to get what I call smoking hot deals, but at the same time, I talk about this a lot. It's not of paramount importance, not mission critical to do a home run every time you do a deal. All right. I'm fine with doing singles and doubles in the process. Deals with a little bit of meat on the bone. So yeah, there might be some competition there where you may pay a price that's not going to make it a smoking hot deal. But some of the best deals I had in my life have been like, singles and doubles, right? Not home runs, but singles and doubles to use baseball terminology. So the one thing about commercial is that things get a lot more creative in that, right? So if there is a property, like I have a client that's got a commercial shopping center under contract that's 50% occupied. Okay, no bank will touch it. No bank will touch it. So they negotiate seller financing with the seller, right? They're paying a great price for it. They're giving the seller a substantial amount of money at closing, and they are. And I just put my calendar link in the actual chat. So if anyone want to grab a one-on-one time, but things can get a lot more creative. And plus, because he's buying it based upon in-place occupancy at 50%, and there's 50% of the space that's vacant, he's getting it for free. Any lease he signs, and I think it's an 8 to retail unit shopping plaza. Any lease he signed shoots the value of the property up enough for him to be able to refinance the property, get all of his investors' money back, and pay that investor. So we're looking at probably like an 8 to 12 month time horizon for doing that. And then the rest of it above that is like gravy. Okay. So those are kind of the two dynamics: less competition with other asset classes, But there's going to be some more complexities. Now, that being said, Roxanne, to answer your question, if you're going outside into other commercial asset classes, I would definitely focus on non-distressed deals. All right. So something that's got like maybe 80% occupancy or higher, right? Something that is stabilized. You can get bank financing on from day one. You do not want to buy a 100% vacant commercial property, okay, that produces no income, or a distressed deal, right? Those are for other things. I've done deals like that, that I thought were going to be home runs. They ended up taking years off my life and gave me a bunch of brain damage in the process. But I really like those ones that like they're stable. They might have been 100% occupied for the past 20 years, right? Indication that they got below market rents. If you have an eight tenant shopping center, right? You can roll through those leases. If a tenant moves out, no big deal. You're still breaking even. And you can roll through that, you can roll through that and reposition that rent roll as those leases roll off and stagger off. So you can, take a property and increase a massive amount of value. And the best part of it is all that leasing and stuff like that. Your broker is doing all the work, right?
Oh,
You put a lockbox on the property, and your leasing broker is going to do all the work and associated with showing the space and marketing the property and that sort of thing.
gotcha. Okay.
Does that answer your question completely?
Well, yeah, no, because you drive around and you see these properties that are half empty, but that makes sense why they're still, viable. But the
Right.
normal person, the uneducated person doesn't realize that, in the commercial space, I guess.
Yeah. So Roxanne, it also leads to my next point too, is that because investor, you're going to drive around, you're going to see, and this is a big fear factor associated with why people don't do, other asset classes outside of multifamily, is that, oh my God, I drive through my town and there's for lease signs in the window that have been there for years. Like
Right.
generally speaking, either that building owner bought that building right, where that space can be vacant and they're not losing money or anything like that because they bought it right. Okay. The other reason why too is that sometimes these property owners, if they could lease that space at below market rents quickly, but they don't want to do that because it has a negative impact on their valuation.
Gotcha.
Right.
Yeah.
So
Okay.
they want to maximize it. They want to get market rents, and they're willing to be patient in order to do that. So I've actually bought retail deals where they've had spaces vacant for several years. And I basically was like, I bought it right. I got the space for free. I was aggressive on the actual rate itself. I don't care because once I sign that lease, it's 100% profit. So I was able to rent out that space within a few months, not 5 years like I saw it was vacant before. So,
Right.
um,
Okay.
and generally speaking, if it's retail, for instance, because we're kind of on the subject of retail, I love these mom and pop owned retail strip centers that are located, not on hard corners, but near hard corners, where there's a lot of national retailers that are scattered around there.
Right.
Good density of national retailers like your Chipotle, your Starbucks, your Walgreens, that sort of thing. That gives halo effect over your product as a retail strip operator. And then and then you're able to get really great tenants because those national retailers, they drive traffic, and that traffic can actually increase the value of your space and make your tenant partners space and business more viable.
Gotcha. Oh, that makes sense. There's a couple places I'm thinking of right now that you mentioned that.
Yeah, absolutely.
Yeah.
Any other questions, guys, before I cut you loose?
Thank you
Okay,
very
cool.
much. Thank you very
Absolutely. I'll send them a follow-up email if you want to grab a one-on-one. Anybody, just let me know. And we'll go from there. Okay.
Sounds good.
All right. Take care, everybody. Bye. Peace.